Hi, my name's Graham Norris. Today is August the 12th, 2024. And today I want to talk a little bit about how we structure the large multifamily deals. I'm going to talk mainly about how we form our team in putting the deal together. There's many other aspects of large multifamily investing that I'm not going to cover today, but we'll cover in a future video. So today, if you would like, take out a piece of paper and draw for me one large circle. You're going to divide that circle up into a 30% slice. So you're going to draw a line from the circumference to the center of the circle, and then again from the center of the circle out towards the circumference, giving you a 30% slice. So you have a circle that's divided up with 30% and then 70%. On the 70% side, put the letters LP. That stands for limited partners. These are people who want to deploy their money in a passive way into the investments, and they get a share of both the distributions on a monthly basis, on a preferred basis. So they get paid first on the distributions, and they also have a share in the equity. Depending on what their share is, depends on how much they put into the project. The 30% is the GPs. These are general partners, and there's four main areas when it comes to the general partners. You have, first of all, the sponsor, and then you have the acquisitions manager. You have capital raisers who raise the capital, and you have an asset manager. So let's cover the acquisitions manager. With the way we have it, we structure the deals. The acquisition manager has a 5% acquisition fee at closing. So he gets paid out of the gates, which is fantastic. He also has a stake. Being a general partner, he has a stake in the deal and a share of the equity. The acquisition manager is responsible for finding the deal, running the numbers, doing the underwriting, see if it meets all the criteria, and getting it to close. So he coordinates with the other team members to get this closed. Principally with the capital raisers, although he might be wearing that hat as well, often does, he will do some capital raise as well. One of the things the acquisition manager looks for is to be at or above the market cap, depending on what market you're in. We like to look for occupancy between 80 and 95%. That gives us plenty of scope to renovate the vacant units and then charge the full market rent for those. And then as other units come up, become vacant, we can renovate those and bring those up to market rent. Our goal for the project is to have the multifamily stabilized within 12 to 18 months. An acquisitions manager gets paid 5% at close of the purchase price. So a very good payday for the acquisitions manager. Other things that the acquisition manager does in the underwriting process is we prefer to have C class assets in a B class location. So there's plenty of scope for improving the outsides of the building maybe landscaping, it might be value add, maybe introducing covered parking, for example, reserve parking, might be adding storage units, coin laundry, all that sorts of things. Anywhere where we can add facilities for the tenants, improving their improving the building, improving their way of life, their lifestyle. Might be even adding a playground, for example, for the children. We make sure that any deferred work is done on the outside. It could include painting, enhancing safety features, maybe renewing roofs, for example. We'll do all that work first, make it very visible. We might put better signage, make it clear. We might put more lighting to increase security. We might even put cameras in if the tenants would support that. So we look for all sorts of ways of improving for the overall community initially, and of course fixing up any vacant units as they come available. We will, if the rents are significantly below market average, we may raise the rents completely for everyone, but those units that are occupied, we will do it in a slower, fairer manner, so it's not too much of a shock, although we want it such that there is people might decide to move, and that's when we can renovate the units. So I look for that. We'll also look at the expenses. That's another area where we can do the value add. All these things will help the bottom line, and it's the job of the acquisitions manager to recognize these things, and this is what makes a good deal. So if the utilities are unusually high, for example, that's important to figure that out. Sometimes there may be opportunity to introduce a pet rent as well on a monthly basis. A lot of apartments, they just charge when they charge the new tenants when the pet first moves in, but doesn't charge monthly. Well, that's something that we could introduce. And there's also various services as well that we could charge for if the tenant would like those. So that's the main role for a acquisitions manager, and as I say, he does raise capital as well, usually. So if you have any questions on that, feel free to book a call with me on calendly.com, Graham Norris. You can reach me on IG, Instagram, with my handle Graham RE Investor. And this picture here is a book that I wrote, Cautionary Tales from Real Estate Investing. For when I first started out, I started with multifamilies and small multifamilies, and progressed now to the larger ones. So don't hesitate to reach out. I'll be delighted to answer your questions. And probably on the next video, I'll cover some other roles at the GP level, and we can go from there. All right. Have a great day.